Welcome to the Boardroom Sessions podcast. In these sessions, we meet the most amazing and interesting people. We learn about their passions, their business models, cool new technologies, and of course, their lessons on personal growth. I hope you enjoy. In this Boardroom Sessions podcast, we meet Shane Shepard, PhD of finance, USC professor, and the smartest guy I know when it comes to the markets and what's going on. If you're like me, you've heard a lot of noise out there about this impending winter, a new recession, a big dip in the market, whatever you want to call it. I wanted to get to the bottom line here and ask somebody who actually knows a thing or two about the economy and finances in general and get a sane perspective. That's what we get here. Hope you enjoy the conversation with Shane Shepard. Shane Shepard, welcome to the Boardroom Sessions podcast.
Thanks, Mike. Happy to be here.
Yeah, so I've heard a lot of chatter, a lot of media, a lot of folks predicting doom and gloom in the in the economic landscape here in the future. And wanted to find out from some folks that I know, some people that are most well positioned to give us some thoughts and advice on the market here. So I thought I'd go to my PhD buddy, USC professor Shane Shepard. You have a PhD in finance.
That's right.
And you got that at Duke, is that correct?
No, undergrad at Duke. PhD was done at UCLA.
At UCLA, okay. And now you're teaching at USC.
Yeah, that's right.
How does that feel?
Oh, it's great. It's a nice environment. It's fun to be kind of with the students and in an educational environment. Feel like I'm able to educate, help others. Kind of help others pursue their future goals and be on the educational side of that. All
right. So I'll call you professor here today. And so eager to have this conversation because I hear so much, doom and gloom, if you will, out there by the media. I gravitate towards positive people, so I get a spin of positivity. I've been listening to a lot of Ray Dalio lately and people like this that are painting more beautiful pictures of the economy, but they're also telling us that there's definitely a winter coming. And so I wanted to find out from you your thoughts on this and first start off by telling us a little bit about what are the indicators that you look at to even make a decision, right? To make a thought and predict what you think it is, because there's so many different things that a layman will look at. My financial advisor looks at different things. Mm-hmm. We're going to talk with him later on the same podcast here, but I wanted to get from you what your thoughts are here on this impending doom.
Yeah, sure. So let's start with high level. There's just a lot of uncertainty. There's always uncertainty. Forecasting financial markets, forecasting the economy, it's a hard game. And so, we certainly don't have complete clarity. I'd be suspicious if anybody comes at you with complete clarity about exactly what's going to happen. But the high level picture is this. From the financial markets, I'm more excited about them today than I would have been at the beginning of the year, right? And things have gone down in price. Yields across the spectrum have come up. That's good. If you're an investor, that's a really good result. And so you could get better opportunities today than you had at the beginning of the year.
And more millionaires have been made during recessions and downturns than at any other times in economic history. So that's a key thing to remember if you have some liquid cash to invest.
Yeah, that's right. Always trying to remind people of the maybe most important adage in finance: buy low, sell high. Well, you can buy lower today than you could have at the beginning of the year. So things are on sale a little bit. That's good. You've got a lot of uncertainty, I think, sort of short to medium term. So kind of through mid 2023, there is quite a bit of risk. Long term, I'm still, very bullish and excited about the United States economy. The United States kind of has a investment opportunity. I mean, I think in the long run, people should be absolutely fine. If you get a long horizon, and if you're looking to buy into the markets today, that's not a bad idea. And if you want to just kind of buy in and continue to hold for a while, I think you should do quite well. Now, doesn't mean there won't be better opportunities coming in the next 6 months or so. That's part of the uncertainty. But things are kind of on sale today to some extent, and so higher yields, higher interest rates. That's good. If you're an investor, that's a good result. The big deals you asked about indicators, kind of the things to look at. sort of the two main things driving everything in the economy right now is inflation and interest rates, right? And I mean, interest rates is kind of the only thing that really matters at this
We've
point.
been spoiled. We've been, particularly in Southern California here where we live, rates have led to lots of flipping of houses, lots of investment in real estate, people trading up in the homes, people buying investment properties. And now it's a almost, skid mark slow in the real estate market with even just a few points. And if you look back in history, I've had mortgages that are much higher than they are today in the past, but I think we've been at a caution.
Yeah, we've been spoiled. I mean, if you're a borrower, low interest rates are great. If you want to borrow money, whether that's to make a purchase, like to purchase a house or to purchase a car, get a cheap auto loan. But if you're a saver, low interest rates actually aren't really good. Low interest rates mean you're getting a low return on your savings, on your investments. And that's true for, clearly it's true for something like a savings account at a bank, but that's true for purchasing, fixed income, government bonds, corporate bonds. And then that's also true that just flows right through to the stock market, right? You get lower dividend yields, you get less potential for capital appreciation. So low interest rates actually aren't good for investors. Higher interest rates, I think, lead to a better investing environment and higher prospective returns. So from that standpoint, I think it's actually a good thing. Inflation certainly a big problem. That's not news to anybody listening here. I like to sort of frame it as,
can you define inflation for folks in general? I mean, it's just cost of things being greater.
Yeah, so you look at kind of the broadest measure, CPI, Consumer Price Index, right? And that's just, if you added up everything that is sold in our economy, right, and put a price on that, and then look at how that price changes from 1 month to the next, 1 year to the next, that percentage change is, how much more you're paying for that basket of everything is inflation. Now, certainly nobody buys everything in the economy, right? So that number is sort of a very broad-based number.
And things can adjust. Some things can go much higher because of scarcity and shortage or backlog, like chips, computer chips, for example. But other things can be more readily available. So you're looking at the aggregate. You're looking at the whole.
Yeah, that's right. And there's been very high rates of inflation on certain things and virtually no inflation on other things. And so it sort of depends on where do you spend your money as far as what your own personal rate of inflation is, right? And consumers are smart and they can do things like, well, if chicken prices are up 50% and pork prices are up 5%, then you just buy more pork and less chicken, right? And that shifts demand over towards goods that have less inflation. But inflation, I guess the classic definition is what? Too much money chasing too few goods, right? And that's a nice way to think about it. And that's really kind of what we've had. And so you think about what have been the causes of inflation. Is either too much money or too few goods. In our case, I think it's both. A lot of people like to point the finger at the Federal Reserve and say they fell down on the job, they weren't paying attention. They're the cause of this. I think that's actually unfair and largely incorrect. I look at it as there's really three primary causes of why we're seeing inflation today.
And that Federal Reserve falling down on the job, meaning they printed more money. Meaning they
kept interest rates too low for too long.
Too low, too long.
And that they should have started raising them sooner. And there is some truth in that, right? The Federal Reserve, they have two jobs, right? And, number one is to keep inflation stable and low inflation. And number two is to promote low unemployment, right? So they care about the health of the economy. They want to keep people working. And those two goals they have are at odds with one another, right? I mean, you could give everybody a job if you just let kind of inflation run very high and kind of allow the economy to run very hot and strong demand for labor, everybody would be working, but inflation would be quite high. But where we find ourselves today is they're raising interest rates, which is going to reduce inflation, but run the risk of creating recession and having people laid off from work and increasing unemployment. So they're trying to balance those two goals.
We're already starting to see some layoffs, right?
Yes,
Some companies Silicon Valley companies in particular, are taking full advantage of this right now.
You've seen tens of thousands of figures in that regard. So the Federal Reserve is part of the story, right? Low interest rates promote spending, right? It's cheap borrowing. People are likely to, if you can purchase a car with a 0% financing, then that's attractive. If you get a 7% financing, that's much less attractive. If you can get a low mortgage or a HELOC on your house, you're more likely to take out money and spend it. If that rate goes up, then people are less likely to spend. So by raising interest rates, they're promoting people to save and invest rather than borrow and spend. And so that takes money out of the economy. That's one of those three factors, right, is the Federal Reserve's control of interest rates. The second factor, which we heard about early on, and I think it's still part of this story, is supply chain disruptions, right? And the idea that we have too few goods, right? So too much money chasing too few goods. Well, we have less goods. It's harder to produce goods. You have people not working as much, not producing as much. There's just less out there to consume. And so you have, even if it was just the same amount of money chasing fewer goods, you would likely see inflation. So the supply chain story is certainly part of how we got to where we are. And I think is still part of it. That's still not completely ironed itself out. And then the third factor, which I think is the primary culprit here, really, is the fiscal stimulus. And that's the money that got put into our pockets from the federal government through COVID relief acts, right? Something to the tune of about $4 trillion. And that's extremely powerful. You put $4 trillion directly in people's bank accounts. All of a sudden they've got the ability to go out and spend. And
I want to touch base on that later and ask your opinion on that topic. I wonder if we overcorrected there, but continue.
Yeah, no, I think that's certainly the case. It's looking back in hindsight, it's easy to say that. We put too much money out there. There was too much stimulus.
Without checks and balances on a lot of them.
Yeah.
A lot of funds were given on a promise, and there was fraud.
Yeah.
Whenever we do those kind of big gifts, there's people that take advantage of it, and to the detriment of all of us, to the detriment of billions and billions of dollars in the economy, stolen or taken advantage of. I think that's a challenge.
Yeah, and the money was not well targeted or well controlled, and it was too large in scope. So you have a bunch of money going into consumers' pockets, and that money got spent, and it's now out there circulating, chasing those small amount of goods, creating that inflation. So those are the three culprits, really. I think, and there's some evidence that shows that fiscal stimulus bit is the largest component of it. The Federal Reserve, their story, they said, we think inflation is going to be transitory. And, if you wanted to take a charitable view of that, I think what they were saying is, well, inflation is largely due to this large fiscal spending, which has been done but is now going to dry up, and supply chain disruptions, which should rectify themselves. And as those things return to normal, inflation should go away. And inflation is not primarily being caused by low interest rates, which I think is largely true. I mean, we've had interest rates close to zero since 2009, right? And have we had inflation from 2009, 2019? What was the inflation rate? Really low, right? Yeah. So if it was just low interest rates, how come there wasn't tremendous amounts of inflation for, over the last 10 or 12 years? We only saw it in the last 12 months. So it's not just low interest rates. Low interest rates, maybe that's creating some dry kindling, right, which fiscal stimulus can set ablaze. But it's not just the low interest rates. So the Federal Reserve, I think, is saying raising interest rates is not really what needs to happen. What needs to happen is fix the supply chain, get people back to work, get them producing things, have Congress stop putting all this money in people's pockets, and then inflation will kind of go away on its own, which I think is largely true. Now, the Federal Reserve can't control any of those other things, though, right? All they can do is raise interest rates. So when push finally comes to shove, they're like, okay, this is the only tool we have. We got to start raising interest rates, and here we go.
And so aren't there any ways in which they could incent businesses to be more robust? Aren't there ways in which I know they tried recently to have a fund associated with getting chip manufacturers to be able to make more chips here in the United States, things of that nature? Can't they pull some levers?
Well, sure. So Congress and the federal government certainly can. They can do lots of different things. The Federal Reserve itself, as the central bank for the United States, they really all they can do is set interest rates and talk, right?
Yeah,
and talking is actually really powerful. They can convey their views, and they can set expectations on future interest rates and things like that, which certainly can impact things. But they can't create legislation. They can't create laws. That's the purvey of Congress.
And we haven't had a cheerleader since Alan Greenspan, right? We haven't had somebody who would go up on microphone and make everybody feel good, and the market tomorrow morning would open up on a positive note. We haven't had that in a while.
No, in fact, the Federal Reserve is kind of doing exactly the opposite right now, right? They're trying to talk investors down. You saw when the inflation numbers for October came out, and they had ticked down, and they were lower, and the idea is, inflation's coming down. The Federal Reserve is going to ease up. We're kind of through the worst part of it. You saw the stock market rally about 5%, I think 4 or 5% on the NASDAQ in one day. And the Federal Reserve, they did not like that at all. They came out and said, people are getting too excited. People are selling bonds, buying stocks, pushing down interest rates. That makes the Federal Reserve's job harder, right? Because people are sort of looking ahead. And so they're trying to talk the markets back down. They're trying to let people know, no, we're still in for a long haul. It's going to take some time still. We're not changing course right away. And so they're actually doing exactly the opposite. They want things to be more gradual.
Why do you think they want to make it caution us all?
Because investor expectations and consumer expectations are actually really powerful in terms of inflation, right? So that is, if people think inflation is going to be 10%, then what happens? People start spending money right away, right? If you think that car is going to cost you 10% more next year, you better buy that car today. And as people start shifting their purchases, to today rather than next year, they start saving less, they start spending more. That's inflationary. People, start changing their behavior. And so the Federal Reserve wants to try and anchor those investor expectations, the consumer expectations, to lower interest rates. And the idea that, interest rates are coming back down, everything's going to be just fine. They don't want people to start spending money that quickly right away. They want to try and take some of the air out of the economy.
Sounds largely emotional, right?
It's very emotional, yeah. It's a lot about just the way people feel about the health of their pocketbook and their consumer preferences. And everybody likes to spend. Everybody wants to spend. And everybody wants to buy things now. That's sort of the American ethos. But we can't all do that, right? There's only a certain amount of goods out there. There's only a certain amount of cars being purchased every year, and you can't have everybody go buy a new car every year. There aren't enough cars. And if everybody tries to, then that's inflationary, and that pushes the price of cars up. That's exactly what we're seeing. Too much demand chasing too few goods.
And so with too much demand, too few goods, the Federal Reserve may be possibly overreacting. COVID, we haven't even mentioned that, right? But that was part of the reason why there was the overreaction, if you will, or the stimulus that came out. All of these factors lead you to run a bunch of numbers, look at the inflation rates, right? Look at the what the Federal Reserve is doing, i.e. Adjusting interest rates, right? And you start to see a picture of...
Yeah, so I think it's still going to take time, right? That is, we're not returning back to a normal economy within the next 6 months, within the next 12 months. It's going to take a little bit of a longer time for inflation to come back down to a more tolerable level. I don't think inflation is going to stay at, if you look at what the CPI has been, 8 or 9%, we're going to come down from that for sure. But it's not going back down to 2% or even 2.5% overnight. I think, a couple of years from now, we still might not be there. It's going to, take time to get there. I would expect it to have inflation running around 3.5% to 4% over the course of the next year or two, which is certainly better. But that's hardly the Federal Reserve getting things back to normal, right? If you think about where interest rates are going to be, we're sitting at about 4% right now today, right? What the Federal Reserve needs in order to combat inflation is for the interest rate to be above the inflation rate, right? You need interest rates above the inflation rate. We're not there yet. We're not there currently. We're sort of barely there if you think about longer term expected inflation, not just kind of what we've seen over the last 12 months. The Federal Reserve needs to have this idea of positive real interest rates, with interest rates around at least 0.5% or 1% above the inflation rate. And that's just that's sort of normal, right? That would be a balanced level of interest rates. In order to actually actively be fighting inflation, they need interest rates to be even higher than that. So you see what the market is telling us. The market's saying interest rates are going to cap out at 4.75% or 5%. That's only going to happen if you get inflation to settle down into the 3.5% or 4% range, which it could, and in which case you'll see interest rates at that level be sort of balanced. So I wouldn't be surprised at all to see interest rates go higher than what the market's expecting. That's really sort of my default assumption, is that we're still going to have higher inflation throughout the course of 2023. We'll be talking about this time next year. Interest rates are going to remain high.
What about unemployment?
Yeah, so then there's this risk of recession, right? So higher interest rates mean, and you're seeing a lot of layoffs. We talked about that. You're seeing, this is the idea of the cost of capital is going up for corporations. So it's more expensive for firms to borrow, right? And in order to hire people, firms need productive investment opportunities, and the higher that cost is for them to borrow money and make those investments, the less of those investments they're going to chase. So they need less workers. They start laying workers off. That's the flip side of the higher interest rates. And one thing that sort of gets a lot of play in financial discussions in the media is this idea of one of the indicators, the slope of the yield curve, right?
The slope of the yield curve,
right? So if you look at
sounds like a test on one of your classes.
Yeah, we talk about it in my classes a lot. You look at what the interest rate is on, the Federal Reserve, they set the Fed funds rate, right? That Fed funds rate is what banks borrow from other banks at overnight, right? So kind of on a one-day basis. So that's a very, very short-term rate. But it's very similar to what you might invest if you were to buy a 3-month United States Treasury bill. But you could also buy a 1-year Treasury bill, a 2-year Treasury bill, a 10-year Treasury bill, right? So there's this different time period over which you're going to lock up your money. So the slope of the yield curve talks about interest rates at those various time periods. And so a common one is to look at what's the 3-month interest rate, compare that to the 10-year interest rate, right? And so that is interest rates are higher in the short run than they are in the long run. And that's what we would call a inverted yield curve, or kind of a negative slope on the yield curve, with high short-term rates, low long-term rates. And what that is sort of a forecast that interest rates are going to come down in the future. Why do interest rates come down? Well, they come down because the Federal Reserve is no longer worried about inflation. They're more worried about a recession and people losing their jobs, and they cut interest rates to try and stimulate the economy. So that's sort of what the bond market is telling us right now through this view on the inverted yield curve. Interest rates are higher today, but over the next year or two, interest rates are going to have to come down, and that's going to be kind of the Fed coming to the rescue of the economy. So there certainly is some risk. That kind of yield curve indicator has been a pretty successful one over history in terms of predicting recessions.
That's pointing to a quicker turnaround in a recession. So it's not like a 10-year curve.
No. That's saying kind of over the next year or two, we expect to see a recession.
Okay.
Right. And negative GDP growth, higher unemployment, probably correlated with lower returns in the stock market. Although we've kind of seen that to this point already so far this year. So the stock market is also forecasting recession.
The indicator,
slope of the yield curve.
Slope of the yield curve is telling you that it will be a short-lived recession.
Not necessarily, no. It doesn't say a whole lot about how long that recession might go for. It's just saying that it's likely recession is going to come. I don't see a lot of evidence that says this would be a longer than average recession, if there is one, right?
What's average?
Average recession is, like 6 to 12 months. I mean, they're varying lengths, but you haven't seen many instances of multi-year recessions, right? A typical recession is kind of 6 to 12 months. Corporations start losing money. They start laying off workers. They start restructuring a bit. Unprofitable businesses tend to shut down. And they kind of restore their balance sheets. Yeah, a correction.
A needed correction.
Yeah. And then kind of, things clear out and the Federal Reserve typically, one thing the Federal Reserve is trying to do is moderate the length of these kind of things in the economy, right? So, we didn't have the Federal Reserve taking this kind of action back in the 30s during the Great Depression, right? The the recession was, depression, right? It was quite long then. If you saw what happened in 2008, 2009, the Federal Reserve cut rates to zero, engaged in a ton of quantitative easing, provided a ton of stimulus into the economy, trying to prop up economic growth. And they were, that was successful in that regard, right? That the recession in 2008, 2009 was not particularly long, right? And the economy recovered pretty quickly. And people got back to work, and firms started investing in new businesses. And so that's likely what we would see happen. I think that, there's no reason that we're going to see a longer than average recession here. It doesn't mean that we won't have one, but
so definitely not 5 to 10 year depression.
I don't see a strong case for that. I think it comes down to how much confidence do you have in the American economy, really, right? You've got strong consumer demand, you've got, strong investment opportunities, you've got, improving technology and productivity, you've got a lot of global enterprises based here. I think, there's no reason in my mind to think that we're heading into a long-term kind of multi-year, especially like a decade-long depression.
Okay. Well, that's positive. I'm very excited to hear that. And so the next question I would have for you would be, there's a lot of talk to now is the time to invest, right? And if you have any kind of assets right now or any kind of investment strategy going at all, now is the time to double down or look for investment opportunities. Knowing that you're not a financial advisor, right? We'll make that disclaimer out front here. Where do you think the opportunities are for investment?
Yeah, sure. So I'd certainly say, 12 months ago was not the time to invest, right? And now is a better time to invest. And 6 months from now might be even better, or I don't know. It's very difficult to predict exactly when sort of that bottom of the market is going to occur, right? So I'm not going to necessarily try to do that.
And that's the big rub, right? So I've heard Ray Dalio say, regardless of when and where you're people see a downturn, they want to pull their money out. Your natural reaction is to want to sit tight and pull your money out. Regardless of whenever that dip has happened, all the best investors in the world will miss the jump. The jump happens unpredictably. It goes in 10s and 20-point market jumps, and you'll miss it if you're not in the market. So the argument is keep going, keep the investment going, keep the savings going into your investment portfolio, even when it's down, so that you can get the gain.
Yeah, that's right. So, if you wanted to look at the bond market, right, you could buy bonds at 1% 12 months ago, or you can buy them at 4% today. That's a lot better. I'm much more excited about buying a bond at giving me 4% return than a bond giving me a 1% return. So from that standpoint, sure, I was very uninterested in putting much of any money in bonds 12 months ago, and that's, a much more attractive opportunity now. Same thing goes for the stock market, right? Stocks are down by about 20%. I'm much happier buying stocks 20% off than I was at kind of this time last year. Could it go down another 10 or 20%? Sure. Yeah, it could. And that's where sort of the belief in the long-term viability of the United States economy comes into play of, where's it going to be 5 or 10 years from now? Most likely a lot higher than it is today. That's not a guarantee, right? And certainly there is a small probability of that decade-long, negative event. But I think for the most part, you're going to see higher values over the long run. You could, if you're a young investor, if you've got a long horizon, certainly buying as the markets go down makes a ton of sense. You're not going to predict the bottom perfectly. Kind of starting to invest now is a reasonable approach. So my personal idea is kind of until the Federal Reserve stops raising interest rates, I think we're going to just kind of keep getting more of what we've been getting. So you'll see that's kind of what I think is likely, is that interest rates are going to be a little higher than what the market anticipates. So, and I could certainly be wrong about that. That's just my own view. But if that's the case, then I think interest rates are going to be going a little higher than the market expects for a little longer. Markets will continue to decline over the next 6 months or so. If you kind of push comes to shove, if you ask me to put a wager on it, I'd say probably 6 months from now might be a little bit better than today. But, that's just my guess. And I think, I wouldn't put too much emphasis on that.
So So largely what I'm hearing here today is an optimistic viewpoint of this is a correction, right? A needed correction based on indicators of overspending, of overstimulus, I'll say. Overstimulus and low interest rates for a very long time. And so this is a natural correction. You also stated that you think it's going to be an average duration. Average duration again was 12, 18 months, something
6 to 12 months, say. In
12
terms of economic slowdown, the stock market will certainly recover prior to that, right? So again, kind of if I'm right, if I'm sort of waiting around for the Federal Reserve to get done, I'm certainly going to miss the bottom. I'll certainly be late to the party.
That's what I've heard from all the greats, by the way, that if you wait, you're going to miss, right? So even my financial advisor, who will be on this podcast as well, is going to say, now's the time to invest because you need to get there for the upswing.
Yeah. And so it comes at kind of, ask yourself the question, right? Are you okay being a little late to the party, or are you okay being early and losing kind of another 10 to 20% over the next 6 months? Because one of those two is probably going to happen, right? And, which error are you more comfortable making?
And then you also said that there's investment opportunities now based on this, right? It's time. Mm-hmm. It's a good time to get into the market and buy. And so all in all, I'm hearing some positive news from Dr. Shane.
Yeah, I think that's right. I think long term, so a time-tested strategy of just, spending less than you make, saving the difference, investing in a diversified basket of financial assets spread across stocks, bonds, real estate, maybe a couple other things, but that's capturing most of it. Primarily, I encourage people to do it in a sort of passive, low-cost way. Keep your fees low. Certainly, if you keep fees low, that's a guaranteed benefit to you.
Low-cost index funds?
Low-cost index funds, yeah. I've spent a good part of my career, creating investment strategies, trying to provide better returns than those low-cost index funds. It's hard, it's a hard job. And, some people can do it. It can be done, but it's challenging. It's hard. And managers, when they charge higher fees, that comes directly out of the investors' pockets. So they got to do not just better than the markets, but better than the markets, in addition to their fees. So it's not clear that most investors are better off with that approach. So yeah, low cost passive index funds diversified across stocks, bonds, a number of different exposures, number of different, not just the United States, but kind of more globally diversified is a reasonable approach too. And have the long-term view, long-term view, time cures all ills in this case, I think. So
yeah. It's all about the long-term view, from what I understand and what I believe. I'm also fascinated by this emotional component here to the whole economic landscape. I think it's a unique thing that we have here in the market, in that it's so highly emotional, right? It's based on greed and emotion, right? And greed and fear. Is that the two things?
Yeah, fear and greed. It's behavioral. I when I teach classes, I like to spend a lot of time talking about behavioral finance, behavioral economics, and sort of the psychology of how people make investment decisions and how that impacts the markets and their returns. And there's a lot of evidence that people, economists like to assume people are rational and make rational wealth maximizing decisions, despite a ton of evidence to the contrary that people make all sorts of mistakes. And a lot of it is based around this idea of fear and greed, overconfidence. Overconfidence is a big one to watch out for. Those two things definitely lead to dislocations in the markets, lead to some opportunities. And I think kind of on an individual basis, just trying to abstract from all that is one of the best things you can do, to just, have that sort of disciplined, long-term outlook, long-term approach. Just follow your, if you just have a regular investment policy of, kind of save a bit of your money every month, invest that in the markets in the same ratio every month, rebalance, periodically. If the stock market goes way down, then put a little more money in stocks. If the stock market goes up, then maybe you take some profits, put a little more in bonds, depending upon what your investment allocation is. But just sort of that long-term discipline, I think, goes a long ways towards helping people escape from a lot of those behavioral and psychological mistakes that we are all prone to.
Super glad to have had this conversation here and get an optimistic viewpoint from a professor on the topic, right? So Thanks, Shane, for sharing your outlook here. Thanks for giving us the investment advice that we're looking for. Thanks for shedding a little light on the emotional components to the market, right? And appreciate your time.
Yeah, my pleasure, Mike. Thanks for having me.
Hey, Mike here. Hope you liked this boardroom session. Please check back to your future sessions as we're recording a new one every month. If you want to reach out, look for me on LinkedIn or send me a note at mike@sidepath.com. That's mike@sidepath.com.